What's up, everybody? My name is Demetri Kofinas, and you're listening to Hidden Forces, a podcast that inspires investors, entrepreneurs, and everyday citizens to challenge consensus narratives and learn how to think critically about the systems of power shaping our world. My guest in this episode of Hidden Forces is Vincent Deluard, Director of Global Macro Strategy at StoneX Group, where he advises large institutional investors on asset allocation, economic forecasting, and quantitative modeling informed by historical patterns and structural economic analysis. We spent the first hour of this conversation exploring Vincent's macroeconomic framework and the key structural forces that he believes are shaping the emergence of a new macro regime of fiscal dominance, including shifting demographics, politically driven inflation, geopolitical fragmentation, and the decline of institutional trust. We also discuss his provocative thesis that recessions have been, quote, canceled, examining the structural and technological forces that he believes are reducing economic cyclicality and reshaping the role of monetary and fiscal policy. The second hour delves much deeper into Vincent's specific investment theses, including his insights on what he calls Asia's reverse currency crisis, his long-term outlook for the US dollar, and an Asian-driven oil demand shock that could rile markets and challenge the ability of monetary authorities to balance their mandates of maintaining price stability while also supporting economic growth and maximum employment. Vincent also shares his suggestions on how to construct a fiscal dominance portfolio, including which asset classes he believes will outperform under the new macroeconomic conditions that we discuss in our conversation, and how investors can best manage risk and reward in this new paradigm. If you want access to all of this conversation, go to hiddenforces.io/subscribe and join our premium feed, which you can listen to on your mobile device using your favorite podcast app, just like you're listening to this episode right now. If you want to join in on the conversation and become a member of the Hidden Forces Genius community, which includes Q&A calls with guests, access to special research and analysis, in-person events, and dinners, you can also do that on our subscriber page. And if you still have questions, feel free to send an email to info@hiddenforces.io, and I or someone from our team will get right back to you. Lastly, because this conversation deals with investing, nothing we say on this podcast can or should be viewed as financial advice. All opinions expressed by me and my guests are solely our own opinions and should not be relied upon as the basis for financial decisions. And with that, please enjoy this exceptionally timely and valuable conversation with my guest, Vincent Deluard. Vincent Deluard, welcome to Hidden Forces.
Happy to be here.
It's great having you on the show, man. This was a long time coming, actually. You're a very popular guest. You've been recommended to me many times. And in fact, one of our listeners reached out to me recently about something. I don't know if he may have been recommending your work to me recently or something else, but I mentioned to him that you were coming on. And he was super stoked about it. So I'm very excited to introduce you to our audience members who aren't familiar with your work. Before we start this conversation, just tell me a little bit about you. What's your background? What's your story? Like, how did you get into becoming an investor?
Well, I guess everyone who works in finance says that, but I'm going to say it anyway. I was really not meant to work Wall Street. I'm French. I grew up in a little town in Burgundy. I was actually supposed to work for the French government, which led me to study economics. And I was really fascinated with economic history. I traveled a lot. I got lucky to get a scholarship to get my master's degree in the US. This was a few years before the GFC. At the time, if you could open an Excel spreadsheet, you could get a job in investment research. Then I thought, okay, I'm going to do that. Initially, I think my idea was the same idea that a lot of guys who start on the sell side is, I'm going to do a little bit of research, and then George Soros is going to be so impressed with me that he's going to give me a couple of billions to manage. Well, that part hasn't happened, but I discovered that I truly enjoy research. I enjoy markets. I enjoy writing. And in a way, I mean, if you have a curious mind, what I do, which is advising a large pension fund on varying topic, asset allocation, economic forecasting, quant modeling. It's really the most interesting job in the world. I mean, you talk to very smart people. You have to be constantly curious. There's always something new hitting. So yeah, I mean, don't tell my employer, but I'd probably do this for free if they didn't pay me.
That's the best kind of work. So you mentioned you got your master's degree in the US. That was at Columbia, right?
Yeah.
And you went to Sciences Po. How do you pronounce that? Is that?
Yes. It was.
That's where you got the equivalent of your bachelor's degree. What did you study during your time at university, and how did that help to shape the way that you approach thinking about markets and investing?
Well, so back in France, this is very kind of almost Renaissance man focused. And now that's a big difference between, I think, the US and the French system. At least the US, very rapidly, you specialize in something and you become very good at something very small. The French system was a bit different, at least for what I did. There was a mix of law, history, math, econ. And I think that helped kind of shape the way I view the world, especially the focus on history. I really think this is something that has been a bit forgotten in the US approach to econ, where it's really kind of quant math focused. I feel somewhat, the econ discipline has a bit of a imposter syndrome that they try to compensate towards the hard science. And no, we can build models too. And look, and then if you write a paper, you got to have all these equations on top. At the end of the day, I'm convinced that, I mean, of course, if you price derivatives, there is a right price and there's a wrong price. But if you think about financial markets holistically, it's a social science and it's driven by historical pattern. And if you ignore that, I think you make terrible mistakes. And one of the reasons I like your podcast is because you kind of bring that historical perspective, which I find quite, unfortunately, too rare on Wall Street. So,
Well, I appreciate that. Your point about economics being heavily biased toward math and modeling is something that I've also found to be true, not only in the social sciences, but even in the case of how philosophy is taught at major universities, where analytical philosophy and logicism would often take precedence, at least in my experience at university, over things like studying the history of philosophy, or in my case, existentialism, and even the works of some of the great Hellenic or continental philosophers. So I couldn't agree more, and I think this opens us up to blind spots because analytical models and formal systems of reasoning are compressed versions of reality. They're meant to simplify whatever problem you're trying to solve or phenomenon that you're trying to understand, and therefore, by definition, inevitably leave things out. And if your only way of approaching a problem is to run it through your model, you're guaranteed to miss something, potentially something critical. And even more importantly, when the foundational underpinnings of your model begin to shift, when the underlying assumptions of that model cease to be valid, not only do you cease to be in touch with reality, but you aren't even aware of it and will often keep using the model in the face of contravening evidence because you've confused the map with the territory.
That's absolutely right. And I think we are seeing one of these moments when it comes to market where we had this era when things look reasonably the same. And also just for availability of data, if you do any sort of quant project, I mean, okay, you're going to get good data for the past 20 years. I mean, the 90s already, it's kind of ancient history. But anything past the 80s, getting pricing, getting good econ data, you're not going to get that. So really, you're looking at a period that, and you can say every period is exceptional, but I guess every period is exceptional in different ways, right? It's the Tolstoy quote about unhappy family being unhappy in unique ways. That period where we have most of the data is quite exceptional. I mean, since the late 70s, we had pretty much consistently falling interest rate. We had falling inflation. We had globalization. We had, by and large, world peace. And these are not normal conditions in human history. They are the exception, not the rule. Yet we train our models to think that this is the norm. So the models will have a tendency to pull you back towards what worked in the past 40 years. And if I'm right about kind of the secular change towards inflation, towards fiscal dominance, towards populism, looking back at such a narrow span of history will actually get you in trouble. On the other hand, if you kind of broaden out the perspective and compare to other eras where we saw similar forces, you'll probably be better off. But it's going to be Unfortunately, it's going to have to be more on the qualitative side because, yeah, we don't have a lot of data on, mid-19th century transition periods.
So speaking of forces, what are the most important structural forces shaping global markets today, in your opinion?
I think at the core, yeah, I would go with fiscal dominance. I mean, it's got a lot of, different terms and it encompasses more than one thing. But I think fiscal dominance is the operative word. I think we came from an era where we didn't have an inflation problem, basically. We had all these forces that conspired in a weird way to help central bankers. We had China opening up the East Asian crisis that devalued all Asian currencies. So suddenly you have like almost 3 billion people working more or less for free. We had the fall of the Berlin Wall that opened up the natural resources of Russia and Eastern Europe to the rest of the world. We had a unique demographic moment in the West, really, when both boomers and millennials were working at the same time. So a very favorable supply of labor. We had a sequence of crises in Latin America that pushed labor in the US with the tequila crisis. And then finally, we had this kind of global savings glut where, because of currency repression, global savings were flowing into the US. So all that really created this, set of wonderful circumstances in the US, which in the 90s we called the Great Moderation. Now, of course, Greenspan being who he is, he took credit for it. There's probably more to that than that. But really, this era, I suspect, is ending. And in the new era, I think what we are seeing is a demographic shock across the Western world, but not just the Western world. I mean, many emerging markets are aging much faster than the US, where a lot of the forces that I described are turning around. And one thing that this demographic shock does is that it really changes the structural balance of governments. Remember, back in the late 90s, we had all this paper about the surplus and how to deal with the consequences of the surplus. And people worried about, the disappearance of US Treasury debt. Well, obviously, this is a problem we didn't have. So you had this kind of structural degradation in the fiscal balance of Western governments, which then causes them to enter in a conflict with the monetary authority. And it challenges what I think was always a myth, the myth of central bank independence. Central banks were never independent. I mean, if you look back at long history, you'd realize that the role of the central bank is to finance the government, period. But we were able to tell ourselves that tale because we had these unique circumstances that it was independent. And I mean, you could see that clash just last week, right? I mean, it was done in a Clooney way with, Trump visiting the Fed and kind of insulting Powell to his face. But that's maybe if I had a summary for what we're seeing, that would be that picture.
Yeah, people, future generations are going to be studying this period in their economic history classes or classes on monetary theory. I'm going to list out a few of the other forces that you've talked about, some of which you mentioned here, and then I want to dig deeper into fiscal dominance. So you mentioned demographics. That's something else you've written about. Geopolitical fragmentation, you mentioned, you didn't use that word, but you described the move from unipolarity to multipolarity. You've also talked about the decline of institutional trust, which is a huge one. Again, these are things that we've talked about on the show, which is really wonderful to read someone else's analysis on them. And then you also talk about, I think you might have mentioned this a little bit, about technologically driven deflation in the 1990s and early 2000s, moving to a period of politically driven inflation. I want to get into these, but let's just dig a bit deeper into fiscal dominance. Can you define fiscal dominance for us in terms of how you use it? And how is it different from monetary dominance, which is this period that we lived in during, I think, especially the post-2008 period where central banks were, quote, the only game in town, and where they were experimenting with all sorts of new and unconventional monetary policy measures like QE, negative interest rates, and even new forms of forward guidance?
Yeah. So fiscal versus monetary dominance is a question about who's the boss at the end, who set the rules. And, there can only be one king. This myth that, the central bank can't ever be independent from the fiscal is not true, because the central bank sets the interest rate, right? And the interest rate is, a huge amount of the budget. So the actions of the central bank have a huge fiscal impact. And conversely, fiscal policy has a huge impact on the things that central bankers look at. So these two things are going to, at some point, clash. And the question is, what happens when they clash? Does the fiscal authority bend? So, for example, if the central bank raises rates to slow the economy in an era of monetary dominance, what that does is that it means that a greater portion of the budget needs to go towards servicing the debt. And that means there's less money to spend on social services.
Which is kind of what we've been seeing in the last few years, no? With the Fed raising interest rates.
Well, yes on the first part, no on the second part. Well, we certainly have seen interest payments increase as a share of fiscal spending. We're spending close to $1 trillion now on interest payments. So that's almost as much as we spend on the Pentagon. And that's the problem, right? That's why Trump is screaming at Powell. That's why Trump is trying to get Europeans and Japanese to buy more treasury debt, because, suddenly you go from, paying zero or even negative rates as we had in Europe on your debt, and then having a $1 trillion item in your budget. Now, what has not happened is the compression of the other parts of government spending. On the other hand, what we've seen is an extraordinarily rapid rise in many of these items. I mean, if we look at Social Security spending, so I like to add Social Security, Medicare, Medicaid, basically the entitlement spending all together, because sometimes you see move from one to the other. So let's look at everything. Since 2022, so excluding the shock of COVID, it's been growing at 10% a year. And this is, around $3.5 trillion in spending between Social Security, Medicare, Medicaid. Okay, so you have a $3.5 trillion chunk of the economy growing by 10%. That's 1.5% of GDP growth right there. That's just happening because people, turn 65 and they become eligible, or they have, they fracture the hip and they are faced with a broken healthcare system that charges them insane amount of money. And that kind of leads me to this idea of permanent stimulus. And this is not something that, it's very hard to get. I mean, we saw that earlier this year. We had a brief moment where it looked like it was going to go like monetary dominance, right? Okay, the Fed had hiked rate. We had this, blowing up the deficit. And for about 2 months, we said, okay, let's look at what we can cut, if we can make the numbers work. And then after 2 months, we decided it was way too difficult to do. We fired Elon Musk, and we had the one big beautiful bill that effectively made it the law that at best, the U.S. deficit is going to be 7% of deficit in the best possible of economic conditions.
So let's dig into the demographics a bit more. I love that you brought up the role of entitlement spending, because the way that we traditionally think about demographics is that they're deflationary. Like, look at Japan, for example. But I had Charles Goodhart and Manoj Pradhan, his co-author, of a paper they'd written some years ago, which became a book, exactly. And they make the argument that you're making, which is that demographic actually, in this type of a world, with all these political entitlements and obligations tied to aging populations, are inflationary. Can you explain why you feel so confident in that thesis?
Yeah. First of all, I recommend people read the book. I mean, they present a lot of arguments. I'm going to focus on just the simplest one, which is the production function and the supply of labor at the end of the day. I mean, an economy produces output, right? And to produce that output, you have capital and you have labor. If you reduce the supply of labor, especially if you're going to pay that labor to do nothing, which was what retirement is, what do you think is going to happen to output, and what do you think is going to happen to price? I mean, you're going to have less output, all else equal, because you have less labor, or you're going to have to replace labor with capital, in which case you're going to need no capital. That's going to push up the interest rate. But all else equal, less labor is bad for output. Let's agree with that. And then you're going to maintain the same level of demand, if not increase it, right? Because a lot of people, when they're in pension, they can actually spend more money because they don't need to save anymore. So you constrain supply and then you increase demand. I mean, if we forgot the age part, right? If we just said, hey, we're going to give basically universal basic income to 30, 35%, we're going to be in a situation where we're going to have 40% of the population retired in East Asia, for example. If we gave universal basic income with no work requirement to 40% of the population, most people would say, of course, that's inflationary. Yet, when they think about 40% of the population retiring, they think it's deflationary.
Well, I'm really glad that you brought that up, because that was going to be my next question, which is, can we apply those same insights and that same logic to thinking about how a very rapid displacement of a portion of the labor force, let's say a white-collar, younger demographics, who are going to be most susceptible to losing their jobs to artificial intelligence. Can we apply that same logic to whether or not that would produce an inflationary result?
Yeah, that's an interesting one. In general, I'm not, and it's possible, right? I mean, no one knows for sure, but I'm not in the camp that we'll have this kind of white collar apocalypse that AI is going to displace everybody. I mean, you can certainly see it in some areas like law. Well, let me take the example of law. For example, I would actually...
Also, podcast production. I was just telling you that I found the first great assistant I've ever been able to find. I've struggled to find a podcast assistant or assistant really in any... I've worked in TV, I've worked in radio, theater. Best assistant I ever had, and I don't pay him... I pay him $200 a month, which is ChatGPT Pro. And so, I mean, I'm seeing it, firsthand.
Yeah. I mean, taking the world of podcasting, I mean, it just makes your podcast better, right? And I think over time that will increase the demand for podcasts, that will free up resources. Going back to the lawyer example, yeah, it's probably a good thing that we stop, paying, close to $1,000 an hour to have someone who went to Brown just, review documents. That was a huge waste of resources. And the question is, what will that person do? I think that person will do something else, and then society will be better for it. I mean, every time we have these transitions, again, it's hard for me to think of an era where we had a soaring unemployment due to technological displacement. That did not happen in the 19th century. That did not happen. The only time, in my experience, when we have sustained unemployment is when we have a demand problem. When, for whatever reason, the government is not spending money, or there's a collapse in trade. You can always create aggregate demand. And that's my point. And that's why I go back to the fiscal stimulus idea. Do we think that the U.S. government is going to shrink its size, is going to shrink the deficit, and is not going to respond to a rise in the unemployment rate? I don't think that. I mean, I think you can always create demand.
Can I introduce a little bit of nuance into my previous question and see how you would respond differently to it? So rather than thinking about it in terms of there being a large wave of unemployment, what if we just think about it either as underemployment or people who experience wage pressures, downward wage pressures, like we saw in the 1990s, early 2000s, the sorts of people that ended up voting for Donald Trump in 2016? Could we see something similar happening, which is that, sure, of course, there'll be and first of all, I totally agree with you. There will be so many great opportunities that will emerge out of this displacement, but also there will be people that won't be able to make that transition. I think many people will be able to transition to something that won't necessarily be as good. And it takes time to do all of that. And my specific concern that I've articulated on this show before, and this is how I want to contextualize it for you so you can respond. My specific concern is that what we saw in 2016 happen on the Republican side could and may likely happen to the Democrats in 2028, and that we could be entering an era where there aren't just, systematic forms of stimulus that are already embedded into the system that we've talked about, but that we could be entering a period of populist-driven stimulus that isn't just happening on the right, but also happening on the left. So how would you respond to that context?
100%. I mean, I think you have the arc there. To be honest, I thought it would happen faster. I think it should have happened. If you think about the populist shift of the Republican Party, I think, starts with the Tea Party movement, which is a revolt after the bailouts, the Iraq War. These guys don't serve our interests, and you had a similar movement on the left. I mean, it was Occupy Wall Street, and then it was the Bernie movement. Now, the big difference is that on the right, the establishment, the barbarians stormed the gates and took over the party, and that process was a civil war, at least internal the Republic, like when Trump runs in 2016. I mean, I remember the debate stage. I mean, he's one man against everybody, and at the beginning it was clear that it was going to be the jabs and the tech crews, and he completes a hostile
he lit that
takeover.
field on fire, and he had that really great moment. I think that was so emblematic was when he attacked Bush and his brother for the Iraq War.
Yeah. And that was. I mean, I'm not a Trumpist, but I remember that moment. I was like, oh, the energy, the raw power that he unleashed was really something to witness. So on the right, it happened. And I think the personality of Trump kind of blurs the picture, because he's, on the one hand, he's the mantle of the disgruntled worker. He's that forgotten man speech. But on the other hand, he's also a real estate billionaire. So and he's got this unique media personality that makes, I think he's more of a transition figure, that the transition will be completed once we move to maybe someone like J.D. Vance in 2028. But at least the Republicans have started this process. Now, going back to my earlier point, on the left, we had the attempted civil war. And then the establishment won, right? I mean, Occupy Wall Street, went pete. And then eventually Bernie was, I mean, depending on how you want to qualify it, was either lost or cheated out of a victory twice. And the elite maintained its control. But it seems to me that this ability to kind of control the base is eroding rapidly. I mean, partly it's demography. I mean, look at, even Nancy Pelosi is going to die someday. Even Chuck Schumer. I mean, we're literally living. This gives me late Soviet Union vibes, when you had all these generals, like 85-year-old generals with like medals. And then they were just like passing power from one to the next until eventually the system went away. And then you see it with, I think, the New York election, where if that option in the ballot, if a populist left option is on the ballot, it's incredibly strong. And I think we have unleashed the beast. And probably by 2028, we'll consider very much a Latam scenario where you're going populist right against populist left. I mean, I feel if the Democratic Party doesn't go this way, it's going to go the way of the Whig Party. Then in British politics, the Liberals used to be the party that dominated the 19th century, and they kind of missed that transition, lost to Labour in the early 20th century. I mean, the Democratic Party, if it doesn't listen to its base, is going to become like a husk. Just a party of civil servants and college-educated women, which really doesn't get you the votes that you need.
Okay, so I just want to tie off two other forces, that major structural forces that you've identified. I said one was the decline of institutional trust, and another one is geopolitical fragmentation. Let's take geopolitical fragmentation next. How significant is this move from unipolarity to multipolarity, as well as not even just the move? It isn't just about the move to multipolarity, Vincent. I mean, what's happening in America is so profound. It's almost like a wholesale rejection of the entire American foreign policy consensus or transatlantic consensus without any clear replacement. It isn't as though Trump is following the recommendations of a cadre of think tanks that have proposed ways of reformulating American foreign policy. It's not clear at all what that reformulation is coming out of the White House. So how do you think about this? The fact that, one, the world order has changed from unipolar to multipolar, and that Washington's role in the world isn't even clear to itself and seems to be constantly changing, and it seems to be sort of chaotic.
Yeah, I don't know if I use the term multipolarity. One of my professors at Columbia was Ian Bremmer, who ended up coming up with that G0 idea.
Sure.
Which I think is probably a more accurate description of where we are, where we just have. So we had this kind of hegemonic moment after the fall of the Berlin Wall, where the U.S. really was like Icarus. It flew too close to the sun, but it could do anything. And I think the moment when the wings starting to melt is the Iraq War, right? Where you see that kind of imperial hubris really backfiring and leaving deep scars, right? And that's where I think a lot of that kind of America first, let's get away from foreign entanglements. Really, the matrix of that is this botched Iraq War.
Yeah, and we lived for a long time, and not to interrupt you, I just want to throw this out there for listeners to just have this perspective in their head as well. I've talked about the Iraq War and then the 2008 crisis as being having laid the seeds for the nihilism that we've experienced in American foreign policy. Because I think that for a long time, Americans were seeing one thing on television, one thing in their regular lives, and another thing coming out of the mouths of their politicians. And that disconnect, I think, is what did so much to cause the decline in institutional trust that we're going to get into next. But please continue.
Yeah. By the way, I think that process of declining trust and sense that you cannot trust what you hear, we're still in it. I think with the Epstein case, we are certainly, the pendulum is still swinging and seems that it's swinging faster and faster. But before we got into that, so we're talking about this. I think it's so more than a shift to multipolarity. It's just the U.S. realizing that it no longer needs or wants to or even can maintain the role that it undertook after World War II, which is probably correct. Maintaining a global order when you just account for about 10% of global GDP on a purchasing power basis. It's going to break you, right? It's the same problem that England had maintaining an empire on which the sun never sets. At some point, it's ironical because the order that you create breeds the seed of its downfall. The U.S., by maintaining global order, by enforcing free trade and ensuring that there was no major war, allowed for global peace and prosperity that eventually made its relative importance shrink and its ability to maintain the system break down. So I think there are two ways we can go from there. One is the grand redesign. You get all the new emerging forces and we agree on a new world order and kind of split things. I doubt that is going to happen, especially with someone like Donald Trump.
We'd have to lay waste to the world or do something to radically transform the power balance in order to get a meeting of the minds like that, wouldn't we?
Exactly. And I think it's the nature of power. Power does not naturally concede, right? The instinct of power, regardless of the person who holds it, is to consolidate. It's very rare that hegemons have had the wisdom to, realize the new world and proactively adjust. In empires, you think about the Spanish Empire, you think about the French Empire, Dutch, the British. They never kind of negotiated their demise with their replacement, right? So that's one path that I think is not going to happen. The more likely path, and which is not a bad path for the U.S., is we don't need that stuff, And I think that's a lot of the impulse behind Trumpism. It's like, listen, now especially with the energy, that's the big key, right? It's like, I think, the U.S. kind of needed to. Why do we need to be in the Straits of Hormuz? Why do we care about the Suez Canal? Is because we imported our hydrocarbons from the Middle East. Now, if we can be more or less energy independent, at least as a continent, including Canada, we don't really need that.
Well, wasn't it also to exert influence and have leverage over the rest of the countries in the world, in particular Europe? Wasn't that also a big part of our presence in the Middle East?
Yeah, absolutely. The question is the cost worth it?
Well, to the Washington consensus, Beltway consensus people, it most certainly was. I think this is where we get into this internecine conflict on the Republican side, but also on the Democratic side increasingly, between the old order and the new order, the old elites and the new elites, right?
Yeah. Listen, it's still very powerful, right? If you look at institutions like the Atlantic Council, the NATO, generations of elites have been trained that mindset. So it's not just going to go gently into the good night, but you really see the cracks getting stronger and stronger, and even on the European side. And it's not an administration story. The thing about Trump is that he makes it more obvious, but there's this continuity between even Obama, I would say, pivot to Asia. Biden was incredibly mean to Europe, when he has the Inflation Reduction Act. It was he kept the tariffs in place, pulled out of Afghanistan. So there is this continuity in policy. Trump just makes it obvious when he or JD Vance goes to Munich and insults Europeans to their face, but it's more difference in form than it is in substance.
Yeah, I also, and not necessarily to go down this rabbit hole, but I also wonder in what sense how different Trump really is. Or Trump says a lot of things. He's very good at making certain statements that you think, oh my God, everything's falling apart. But I believe we've doubled down on our commitments on Ukraine. And this is after him, excoriating Zelensky and dressing him down in the White House, which I think was part of his strategy to try and get concessions from Putin. But Putin knows better. Putin's already been on this rodeo many times. He knows the power of the, quote, deep state. He knows the power of the consensus. And he I don't think, has been surprised by this. And he certainly wasn't lulled to sleep by Trump's performance. And I think I saw something on my Twitter feed this morning about him denying the Taiwanese president the ability to land the plane in the U.S. or something like that. Again, this is me just trying to remember it, but this is, again, another example of, I think, him trying to win points, score points with his counterpart, in this case, Xi Jinping, during negotiations. But I quite, there's some people out there that say there really is a strategy here, and I don't see it. I really don't see it. I feel like what drives the public announcements of the Trump White House is his need to generate attention and his political instincts.
Yeah, again, I agree with you. I think maybe a kinder way to put it for Trump is that his strategy works with the weak. He's strong with the weak and then weak with the strong, right? So you see it in the EU deal, for example. I mean, by all standards, I mean, just looking at the reaction, how pissed off the Europeans were, yeah, he probably got a good deal with the EU. With Japan, more balanced, but, I would say he still got a deal. Now, it's no surprise we don't have a deal with China, right? So in a way, it's kind of like taking your sister to prom, like, yeah, we can force the European and the Japanese to be our dominions, and eventually, yeah, at the end of the day, we pay your bills, we can force. But again, it's no great achievement to bully your allies and extract better terms from the relation with people who are already under your dominion. It would be more impressive if we had the same thing with countries that are adversaries. And then so far, I agree with your assessment. I mean, on Ukraine, it was supposed to be solved in a day. It's been many, many days. And then with China, yeah. So, it's exactly the way you describe it, where you have the my Frenchie, and then you offer some kind of token symbolic gesture, hoping that he takes it. But again, I think that the problem here is that, common problem in human negotiations, we project that the other people want what we want. And Trump, as you mentioned, wants attention. He wants symbolic victories. He wants almost these ritual humiliations, or, like we had with Zelensky, like we had with Powell, like we had with Ursula von der Leyen yesterday. He wants the face and, big number, and then the outcome doesn't matter so much. Now, for someone like Xi or Putin, who are basically president for life and who do not need to be reelected, these things don't matter too much. They actually care about the substance much more. So that's why I think the strategy of like giving them, optical wins doesn't work.
I think also, and then we'll move on from this. I'm sure we've exhausted people by talking about Trump, but I think also Trump's negotiation style, I think, works very well when his counterparts have a vested interest in maintaining whatever system it is that he's operating in. Even during the 2016 elections, if you remember the way he ran, he was willing to sort of like, rub shit and mud all over his body so that no one wanted to touch him. Mm-hmm. No one wanted to participate in the form of debate that he was willing to pursue. And so people sort of just made concessions. And I think the same is true, for example, perhaps in his negotiations with Europe. Europe doesn't have a lot of leverage. Europe is desperate to maintain the system as it is. But the Chinese are very happy to tear it all up. Yeah. I mean, obviously, they don't want to tear up the international trade and access to U.S. markets, but they certainly don't want to perpetuate U.S. unipolarity or a U.S.-led international liberal rules-based order. Same is true for the Russians. And so I think Trump's art of the deal politically has gone from, I think he's very good at tearing up the deal, but he's not very good at sealing the deal. And that's where he finds himself. He comes in guns blazing, and then it's kind of like everything peters out, and it's just a mess on the floor, and there's no one there to pick it up. So I just want to bring us back to the conversation we were having before. We talked about these different structural forces. The very first one was fiscal dominance. Fiscal dominance, as far as I've been able to tell, is also one of three key theses that I've extracted from your work. The other two are this notion that recessions have been canceled, which I love and which I'd like to talk about, as well as this thing that you've described as Asia's reverse currency crisis, which is a reference to the currency crisis of 1998, of the late 90s that started in Thailand. No, it was not Thailand. Where did the crisis begin in 1997?
Yeah, no, it was the devaluation of the Thai baht.
It was the Thai baht devaluation.
Also, yeah.
So one more question about fiscal dominance before we go into some of these other theses, and that has to do with historical parallels. Now, There are two eras that people point to as being potentially similar to the era that we're going to move into. One is the period of stagflation in the 1970s, and another is the period of the Fed Treasury Accord post-World War II. Which one do you think bears most resemblance to the world of fiscal dominance that we're entering?
There are elements in both, but if we focus on fiscal dominance, and I think that's the correct way to think about it, because it is like I said, it is the engine at the end of the day. Pretty much every problem we have, it comes from the fact that we have to pay $1 trillion interest every year, and we didn't have to. So if we use fiscal dominance as the operative engine, it's the late 40s, early 50s, not the 70s. The 70s is actually the exact opposite of fiscal dominance. It's a conflict between fiscal and monetary that is won by monetary. It's the triumph of monetarianism over fiscal. And you remember we had these fights between, Nixon insulting the Arthur Burns, and then how does that end? I mean, that ends with Volcker, giving up, letting go of the interest rate, let it go as high as it goes. I want to control money supply. And that really is a triumph of Friedman. It was, in a way, like if you think about a current scenario, the analog of the 70s with Brazil today, where, you have Lula that's, spending like a madman, and then the central bank that's hiking, and then the economy that's overheating and kind of stagflationary condition. But fiscal dominance is the exact opposite of that. It's what we had during World War II, when I think after Pearl Harbor, basically the Treasury told the Fed, listen, you're going to buy every single 10-year Treasury above 2.5%, and you're going to keep the Fed funds rate at, I think it was 3/8. And that's it. And I think that's clearly that world that we're going into. Now, Powell is, seemingly putting up a fight, but, it's going to end fairly soon, May, if not earlier. And eventually, I think we'll end up in a world where we do have some sort of yield curve control, some sort of capital control, exactly like we had in the late 40s. And it really matters because if we think in terms of asset allocation, you have two drastically different outcomes, right? 70s, horrible bear markets for stocks, basically sell everything, buy gold was the trade, or the Swiss franc. And there'll be some elements of that. But in the late 40s, early 50s, really what worked even better was stocks. And if I look at market action, we certainly see gold and crypto do very well. But we also see stocks, rising by about since COVID, we're probably at 12, 13% a year. I mean, we had these sharp bear markets, and I think we'll keep having them, but they don't last very long. Why they don't last very long? Because fiscal dominance is very good for stocks. What's fiscal dominance effectively? It means that the government supersedes interest rate, keeps negative real interest rate, which is great for companies, right? Because companies borrow money. So if you can borrow money for less than inflation, your bottom line naturally expands. So you compress the cost, and then the government deficit is no longer constrained, right? You just spend as much as you want. Well, when the public sector has a deficit, the private sector has a surplus. So that means you're giving money either to civil servants or to private contractor, and eventually that money gets into corporate profits. So you boost demand and you reduce costs. You also keep interest rates low, which means that equity multiples are much higher. So it's extremely bullish for stocks, at least the first couple of years of fiscal dominance. Now, if you get into a scenario of hyperinflation, and eventually I think it all unravels, but I would not rush to the end. I think a lot of people have this tendency, especially people who've studied emerging markets crisis, like they recognize the sign. I mean, it's very easy if you look at Brazilian history to see a lot of parallels between, the many crises that Brazil had and the US have today. But again, the US is not Brazil. And we have a lot of levers we can press before we get to that end game. And for now, we are still in that process where fiscal dominance is boosting nominal growth and is helping stocks. So stocks should remain a core part of the portfolio. What becomes the victim of this is treasuries, and especially long-term treasuries, as we have seen for the past 5 years.
So how do these insights relate to your proclamations that recessions have been, quote, canceled? And what do you mean when you say that?
Well, one thing is just an empirical observation. When was the last recession? COVID obviously doesn't count, right? I mean, we shut down the economy, and as soon as we reopen it, we're growing at 10% nominal. So that was not, it's like 1 month. I guess the NBER still calls it a recession, but for practical matters, no, you have to go back to 2009, right? That was about 16 years ago. And then before that, in the 90s, that was, like I said, the Great Moderation. No maybe like a blip here and there. You can say maybe 2001, there was a recession, but it depends what definition you use.
Same thing with 1990, 91. It was a very shallow recession.
Exactly. Same in the 80s, we had the Reagan boom. So we only had one serious recession since I've been alive, which, if you think in terms of portfolio construction, the idea of a traditional 60-40 is your stocks are here for the growth. Basically, your bonds are here for the recessions. Like, okay, are you going to put 40% of your portfolio to hedge against something that happens once every 45 years? That seems a bit excessive. So part of it is, like I said, an observation that the frequency of recession has dramatically dropped over time. Now, we can ask why that is the case. I think one...
And the types of recessions, too, just that observation. The additional thing to observe is that the 2008 financial crisis was a credit crisis. Was a credit-driven recession. It wasn't your typical sort of business cycle-driven recession where you have, a period of liquidations followed by pent-up demand and a boom. And so, we've also seen less of those as the economy's gone from heavy industry to services, and technology and high margin.
Yeah, I think you point the structural technological explanation for this. I think there are two parts to my theory. One is the optimist, the beautiful part, which is what you point out. I think the economies are getting structurally more resilient. And then there is a possibly darker side, which is policymaking becoming this kind of constant stimulus era and rise of populism and lower tolerance for recession. But yeah, the first part is what you said. I mean, it's, we moved, in the colonial era, we had an agricultural economy. So like a bad harvest, and here you go, you have a recession, right? And then as we moved to industrial economy, we had different causes of cyclicality. It was the inventory cycle. It was the capex cycle. When you build a bunch of railways, everything picks up, right? Steel demand, whatever. And then you do too much of it, everything collapses at the same time because the engine of wealth was hard assets, tangible assets, steel, plants, manufacturing, and so forth. Now we move to an economy, like you mentioned, that's 80% service. And also, I would point about 35% government spending and 20% healthcare, which is extremely resilient. So there's still a cyclical component in the economy, of course. And we see weakness in that cyclical component. Housing is terrible, auto sales are terrible, but they are not big enough to tilt the economy in recession. At best, what we get is kind of stagflationary fear, right? Growth goes from 3% to 1% and inflation doesn't come down, but we no longer have this recession. The last thing I would mention about this is the rise of intangible assets, which I think really matters, is how we produce value, right? Are we producing value from coal mines and steel plants, which require financing, which assets that need to be depreciated over time? Or are we producing value from network effect, intellectual property, trademark? Most of the value today, like if you were to buy the NASDAQ 100 today and you were to, just sell it, everything, and then try to realize, what you can get. So you'd sell the servers and you'd get 1 cent on the dollar. So tangible book value is almost nothing. And again, intangible assets behave very differently. You don't need to finance them. Most of them, they just grow naturally, right? I mean, you have more people go to your network. You didn't take a loan for that. It just kind of happened organically. You don't need to depreciate them. So again, that takes away the cyclicality of the economy. And that is a process that's most advanced to the US. In a way, I think we've kind of outsourced a lot of the things that are cyclical, like manufacturing, like mining, like agriculture, to other countries, which did experience a cycle, and we kind of kept the intangible things. So that's the technological part, which I think is the more important driver over long periods of time.
Well, so I'm very excited to dig into this more, specifically to dig into what the changing global security environment and the professed need by governments to build resiliency in their supply chains and redundancy in their domestic manufacturing bases mean for the types of companies and equities that will perform better in this new paradigm and how those differ from what did well in the previous paradigm. But we're going to have to leave that for the second hour. I have one last question to ask you before we get there, which is about policymakers. How did the structural changes that overtook the American and to a lesser degree some of the European economies transform the role of policymakers, in particular central bankers, during the period of the 1990s and early 2000s? And how did their own self-conception of that role change when they became, quote, the only game in town? And we began to see an increasing amount of mission creep by central bankers who were increasingly taking on the roles previously assigned to elected officials?
Yeah, so that deflationary post 1980, 1990 era really freed policymakers and especially the central banks, right? Because suddenly the inflation concern, which usually is really the binding constraint in monetary policy, was no longer binding. You didn't have to worry about inflation because we could get stuff from China for cheaper and cheaper. We had this, free labor from Mexico. We had free capital, long-term rates, which usually was the plague. The Fed it's not a dual mandate, it's 3 mandates, right? Stable price is not 2%, but stable price is low unemployment and long-term interest rate. But 2 of these problems were solved. The price is, if you look at the CPI, basically the cost of service, college, healthcare was way above target. What allowed the target to remain at 2% was the cost of toys, electronics, clothing falling. That's nothing to do with monetary policy. But anyway, and then because of the great recycling of capital through the Chinese current account surplus being reinvested in treasuries, the cost of long-term capital falls. So suddenly central bankers are kind of Icarus again, right? The gods, they can do many, many more things. And that's where you start to see the mission creep, right? I think if I had to pick up a date, it would probably be the LTCM debacle and Greenspan doing these insurance cuts and then bailing out the market. Why? Because it could. And then you do it once, well, you have to do it again. And it happens again in 2007. And then
because that also reinflated the dollar carry trade.
Yeah.
That kept it going. That kept the system going.
Yes. This idea that, it's kind of, the Fed put, right? That's when these things started to appear. That's almost like a 4th mandate. And it's, I think you used the word mission creep. That's what any bureaucracy, its natural tendency is to grow and find more things to do. And you can see that in the staff at the Fed. And then, now we've come back on it, but there were talk about putting climate change. The ECB, for example, and the Bank of England are trying to keep the planet's temperature from preventing it from rising by more than 2 degrees. How you do that with the overnight rate on bank reserves, I don't really know. But so you had this basically giant mission creep that was enabled by this low inflation era, which then creates the expectation that they should act. And I think that brings us to the current era where we have this policy activism, both monetary and fiscal. Like if something bad happens, you need to fix it. And the fix invariably is going to be, I think, inflationary. I think every time you have a shock, you basically have 2 options of the policy maker. One is the kind of Taoist version, trust that nature is healing, do nothing, and things will get better. And then quite often it works like that. There are recessions that cure themselves. But that means that for a little while, you accept that output is going to be below potential, that maybe the unemployment rate is going to go up, but that eventually humans being intelligent, they'll figure it out. And then you have the other instinct, which is to compensate. And I think we're moving from an era of letting things happen to not just compensate, but overcompensate, right? We certainly saw that with COVID. COVID was not inflationary. For example, in China, it was deflationary. What was inflation? It was a response to COVID and the overreaction to COVID. Same thing with the Russian invasion and the shocks to commodity prices. We saw that in Europe, that Macron called that quoi qu'il en coûte, whatever the cost be. Oil prices are up. What am I going to do? I'm going to send people checks so they can buy more. So you can see how policy, by overreacting, makes the problem worse and creates this era of permanent stimulus.
So that's brilliant. I want to try to encapsulate what you said in a way that maybe can help even more people understand it. Or at least this is my insight, which is that the response is what's key here. We talked about early on in this conversation about the danger of being wedded to certain frameworks and models when the underlying assumptions that undergird those models change. And here is, I think, one of the keys, which is that let's just take demographics as a great example. We traditionally think of demographics as deflationary because older people are not consuming as much, and therefore that's going to cause downward pressure on prices. But in this case, if the government is there to help them consume and they're leaving the workforce, it's a double whammy of being an inflationary impulse. So the response function of policymakers and governments is one of the major changes that I think, we have to really take into account when making projections about the future.
And one thought that I had as you were talking is about that link between this hyperactive policymaking and aging, which doesn't seem, naturally, you think old people are not going to be, they're going to be conservative. That's not true. I think if you think in terms of human capital, that explains the reaction. When you're in your 20s, you can compensate, right? There's a bad outcome, there's a recession. You have, 60 years to make up for the losses. So you have a higher tolerance for pain. When you are 80 or 75, you have a significant share of the population that's retired. You just cannot have a recession because people are not going to be they don't have a job to come back to. They won't, learn to code or whatever. So you need to preserve the system at all costs. You cannot allow the economy to fall in recession. And more importantly, you cannot allow asset prices to fall because people are living off assets because they're no longer working. So I think that's one of the underlying drivers of this. Both so on the fiscal side is prevent the economy from going into recession at all costs because we can't afford it. And then on the monetary side, it's prevent asset prices from falling because we have the most politically active cohort that relies on stronger asset prices. So you put these two things together and you have something like Trumpism where, you're constantly at the same time being populist on the economic side of things to try to almost like Peron in Argentina, where you try to keep the economy running hot. And at the same time, you bully the central bank to prevent interest rates from rising because you want asset prices to remain high because you know that your base of aging boomers need these high asset prices.
Right. And that's also a unique feature today, which is that people's retirement accounts are wrapped up in the stock market. This wasn't the case 80 years ago.
Which you can think is, I would think it's a crazy idea personally.
And that becomes another political liability. Again, this is now a liability of the government.
Yeah, absolutely. Now the government has to be in charge of, because socially we cannot, there's no government, no democratically elected government that can accept that the present value of future pension benefits drop by 50%, which is what the equity market will do. If you let it to its own device, every 10 years or so, you're going to have a 50% drop. Imagine, if you told your 85-year-old grandmother, oh, sorry, we're going to have to cut your check by 50% because, we adjusted the discount rate. And no, so that's the inherent contradiction of using the stock market as a way to fund the retirement of people. The stock market should be here to fund the operation of companies, not retirement. But we've crossed that bridge already. And now we are in that world and we have to live with the consequences. And the consequences, we cannot tolerate the stock market to drop because it has much larger social implication than just raising the cost of capital for companies.
So Vincent, I'm going to move into the second hour. I want to tie off one more thread related to the conversation about the cancellation of recessions, and that has to do with how creative destruction works today, because you have some really interesting insights about the role of venture capital and private equity in sort of replicating the liquidations that come from the Schumpeterian cycle of creative destruction that recessions generate. I want to talk about your framework on Asian reverse currency crisis, but again, we're going to have to sort of manage our time here because I also want to make sure that we talk about how to construct a fiscal dominance portfolio, what portfolio construction should look like, the key asset class that you think will perform well, and the larger implications for investors. For anyone new to the program, Hidden Forces is listener supported. We don't accept advertisers or commercial sponsors. The entire show is funded from top to bottom by listeners like you. If you want access to the second hour of today's conversation with Vincent, head over to hiddenforces.io/subscribe and sign up to one of our 3 content tiers. All subscribers get access to our premium feed, which you can use to listen to the rest of today's conversation on your mobile device using your favorite podcast app, just like you're listening to this episode right now. Vincent, stick around. We're going to move the rest of our conversation onto the premium feed. If you want to listen in on the rest of today's conversation, head over to hiddenforces.io/subscribe and join our premium feed. If you want to join in on the conversation and become a member of the Hidden Forces Genius community, you can also do that through our subscriber page. Today's episode was produced by me and edited by Stylianos Nicolaou. For more episodes, you can check out our website at hiddenforces.io. You can follow me on Twitter at Kofinas, and you can email me at info@hiddenforces.io. As always, thanks for listening. We'll see you next time.